Jacob Schmidt, founder and CEO of Schmidt Research. And Jacob, you're saying that in 6 months' time, we won't be talking about this. It'll all be forgotten.
Absolutely, because first of all, let's put it in perspective. 2.3 billion is a lot of money for you and me and for most firms. But for UBS, it is not a lot. Yes, it is part of their equity. It is painful. It's 5% of their equity capital base, but they can digest it.
But what about, how is this going to affect the actual investment bank? Because there had been concerns about the way it was being reshaped. Can we expect that that unit will be scaled down in some way, or that at least internal risk controls will be beefed up?
Absolutely. I think the reputational damage is huge. I think for the next 6 months, that is why I think it's 6 months, there's not going to be any risk taking over there. So risk will be reduced significantly. So traders, whether prop trading, definitely, but also client trading will be reduced to a minimum. But then after, usually 6 to 12 months, people come back, markets come back, and within the firm, there is then probably a new risk management, and we will have forgotten about
So what do you think investors want to hear in order to regain or to at least boost their confidence in the aftermath of this? What needs to happen within UBS to make people feel perhaps rather more comfortable when it comes to
I think they want to hear
company?
3 things. Number one, risk management. How will risk management have been improved? Because it's unbelievable that you don't see a loss of 2 billion. People must have seen that, margins and so forth and so on. Secondly, external due diligence. Where were the auditors? Where was the central bank? Where was the FSA? Where was the Swiss regulator? And thirdly, the culture at the banks and at trading. There is a culture of excessive risk trading, and that has to be addressed. I think that is really what the investors want to see before they see that I think UBS is not investable.
Well, Jacob, just want to move on to your thoughts on the wider markets now, and just to run through some of the main things that you're thinking about Greece. It's going to move, you say it's going to move closer to default, but you said it won't happen, that it won't happen in the next 2 weeks. You're saying that equity markets seem undervalued right now, but they could be set nevertheless for further falls as the crisis unfolds. You recommend gold and silver as the ultimate hedge against any panic scenario. So then let me get your thoughts then, if you could expand on that first point there. Is a default priced in?
It is somewhat priced in terms of the Greek bonds, because the Greek bonds that are trading in the 30s, they can trade as low as the 20s or 10s, and we've seen that in other countries in the past and so on. I think the writing is on the wall. Greece will default. It's a question of when. If we listen to Angela Merkel of Germany, then it's going to happen in 2013. But it's probably a semantic thing of when it will happen. It will happen either in 2 weeks' time or in a year's time. The question is, how is it going to affect the markets? And there are 2 scenarios. The one is, it's a Lehman scenario, and the markets will collapse. The other one is what we call a coordinated controlled default, which I can't believe, but it is possible. And under that scenario, equity markets could actually rally. And we see that the people are actually positioning in that. In the event of default, the bad news is out, and I can go back into equity markets. Because let's not forget, equity markets have been punished for the debt problem. And that does not make any sense per se, because many companies are very healthy out there.
But as you say, equity markets seem undervalued. They could be, but you're saying that they could be set for further falls. Does that mean that it's not the right time to get in now?
What we see and what we think makes a lot of sense is to be in the equity markets on a hedge basis, to be in good equities, but to be hedged. What we see a lot is people are long shares, short indices, short futures. Hence, we have a lot of pressure on the indices per se, and markets move a lot. But as soon as the problem has been removed and the Greece problem has been addressed and has been solved, equity markets can come back, because then the big equity markets, like the German market and the US market, would have a lot of upside from here.
I mean, as you say, there are strong blue chip companies with a great deal of cash on their balance sheets and liquidity buffers, I suppose, even in the event that there would be a credit crunch that you described, a worst case scenario. But does it look as though investors are distinguishing between those companies that are genuinely risky and then those that actually yield some pretty good returns? It seems as though there is a general fear in the market that means there is just this complete aversion to risk.
Look, the real risk is in the financials. And the financials are going to suffer. Somebody has to suffer in a Greece default. And it's going to be the financials, the one way or the other. If we socialize the problem, then everybody's going to be penalized. Then potentially via taxes, the entire stock market could suffer from that. And potentially there's a contagion. If we can separate it, if we can save the banks, and that's why we think Greece will default and the banks will be saved and not Greece. So the EFSF at some point in time will become a TARP solution whereby we can help the banks, but unfortunately we can't help Greece, and it's probably going to be better for Greece not to put new money, to put good money after bad money, and hence we think that it's the equity market which could benefit from that.
So you think the banks will take precedent over the sovereigns, right? Thanks very
Absolutely.
much indeed for speaking to us, Jacob
Pleasure.
Schmidt, founder and CEO of Schmidt Research.
Pleasure.